Mr. Market, a pilot, when asked about his job, joked that my work consists of many boring days intertwined with a few horrifying moments. If this pilot were to engage in the field of investment, the author is quite certain he would notice that the market operates, similarly to aviation, a long series of monotonous periods punctuated by a few terrifying events. However, when we talk about the market, what exactly are we referring to? The market is essentially a collection of participants trading stocks with one another. Stocks, to be most accurate, represent a legal ownership stake in a company. Participants with varying levels of knowledge and perspectives on each company's prospects collectively set the common price for the market at any given time. Abstractly speaking, the market's will is the aggregated and balanced will of all its participants. If the collective will is positive, the market rises. If negative, the market falls. Benjamin Graham, the mentor who shaped the legendary Warren Buffett's investment style, introduced the concept of Mr. Market in his book The Intelligent Investor. By personifying the market, Graham implicitly suggested that the market essentially thinks and acts emotionally like an ordinary person. When exuberance and greed surge, Mr. Market will quote very high buying and selling prices because he's afraid others will snatch away his profit opportunities. When he's depressed and fearful, he can't see anything beyond an impending apocalypse, believing the world is about to perish, and all he needs to do is sell everything as quickly as possible and hide in preparation for the upcoming crisis. Mr. Market is a flawed character. He continuously offers different prices for the same business. He won't blame you if you completely ignore him. His job is to quote prices. The investor's job is to decide whether those prices are attractive enough to accept. The decision to trade lies entirely with the investor. Mr. Market can't force you to follow any of his requests, unless you're fully margin, but that's a story for part 4. If you don't like today's buying or selling prices, that's okay. He'll come back tomorrow with different prices and continue doing so in the future till you find a price that suits you to decide on a trade. One extremely important thing investors must remember: Mr. Market exists to serve your interests, not to tell you what to do in each specific situation. Investors have the right to completely ignore the market if he's going crazy, or to fully take advantage if he's making pricing mistakes. If an investor believes they cannot make entirely independent decisions apart from the market, then they simply shouldn't participate in investing in the first place. As the famous poker saying goes, if you've been sitting at the poker table for 30 minutes and still don't know who the fool is, you are the fool. But that doesn't mean Mr. Market is always insane and foolish. Although in the short term, under the strong influence of emotions, he may quote absurd prices completely detached from reality. In the long run, as reason gradually replaces emotion, he prices businesses extremely accurately. After all, it's very difficult for you to stay insane for an extended period. It's exhausting, and no one is foolish enough to remain that way. Reason will recover, and Mr. Market will realize he made a pricing mistake and quickly correct it. As Benjamin Graham said, in the short term, the market is a voting machine counting the votes of who is popular or not. But in the long term, it is a weighing machine assessing the true value of a business accurately. This brings us back to a point the author emphasized. As an investor participating in the market, the decision to buy or sell always lies with you. The market's role is to provide prices. Your role is to decide whether those prices are favorable for you to act upon. You don't need to continuously trade with Mr. Market just because he's always begging you to do so. This is the fundamental advantage that any investor participating in the market possesses. You have full authority to decide whether to buy or sell based on the market prices provided. If you dislike what he's offering, you have the right not to participate, and he doesn't care. He'll show up again tomorrow with different prices, and so on until you decide the price at which you want to transact with Mr. Market. Any investor who lets daily prices influence their investment decisions is turning their fundamental advantage into a fatal weakness. You go from being the decision maker to being forced to act according to the market's whims. By constantly paying attention to and listening to the daily noise of the market and making decisions based on that, the investor is turning themselves from a boss into a slave serving the market. Imagine you are a coffee addict, and your habit is to visit a cafe daily to savor a cup of coffee in preparation for a new, energetic day. Would you feel happier or sadder if the price of coffee decreased each day? If you feel happier buying a cup of coffee at a lower price than the day before, why do you feel disappointed when the price of a business stock drops or excited when it rises? Many investors feel excited when the market goes up but disappointed when it goes down. This is an irrational reaction if what you desire is to buy shares of companies for future growth. As an investor, your task is to find quality businesses to invest in for the company's growth purposes. The cheaper you can do this, lower stock purchase prices, the better the profit prospects. Frenziedly buying, chasing stocks when the market is rising, or panicking to sell everything when the market is falling are fundamental mistakes that can lead to losing everything in an instant. All investors hope to achieve a good enough rate of return compared to the effort and time they've invested in researching business operations. However, what does good enough mean? A return rate of over 10% or 20% or simply not losing money is good enough? Without a benchmark, we cannot truly know whether our investment performance is good or bad. If you think merely having a green account profitable is good, you are making a fundamental mistake like novice investors. If the market rises by 10% while your account only grows by 3%, your investment performance is worse than someone who did nothing but invested in a market mimicking index fund and then forgot about their account. You spend a lot of time and effort finding investments you consider most promising, but your return rate is only 3%, while someone else, without any research, simply invests in an index fund tracking the S&P 500 and achieves 10%. The S&P 500 represents the 500 largest publicly traded companies in the US. And since their combined market capitalization is large enough, an index fund mimicking the S&P 500 will have a return rate nearly equivalent to the overall market's return rate. The market itself is the benchmark for comparing your investment results. If you can't beat the market, there's no reason to actively invest at all. All you need to do is buy a market-mimicking index fund and you will achieve the market's overall return rate. This is passive investing, which most people, without the time to monitor the market, are practicing. However, is it really easy to achieve a return rate higher than the market? Eugene Fama, a renowned economist, even considers this impossible. He believes that trying to beat the market is foolish because only fools attempt the impossible. He even has a famous theory to prove this point: efficient market hypothesis. In 1959, Eugene Fama took a part-time job for a professor who provided financial market forecasting services to interested parties. Obsessed with the market, Eugene continuously studied past price models and compiled statistical probabilities to find predictive patterns about future trends. He always tried to discover information that could give investors an advantage by predicting how the future would unfold. He always failed in this endeavor. The information he found wasn't sustainable enough to become a reliable advantage. With this rather painful market experience, he pursued a Ph.D. at the University of Chicago and wrote a dissertation on one of the most famous theories in modern economics today. He is the father of the efficient market hypothesis, EMH. The theory's foundation is that the price movements of companies in the market are entirely random and unpredictable. Therefore, having a more accurate view of a company's value than the market is an illusion because all information that could affect a company's value is already reflected in the market prices. Of course, some investors will have better returns than the market for a few years, but that's merely a lucky break. And no one can consistently beat the market for many years to prove that investment skills truly exist. All those who have beaten the market are just lucky fools, and they don't even know it. Eugene Fama uses the example of a monkey flipping coins to counter those who cite investors like Warren Buffett, who consistently beat the market. Imagine a coin flipping contest for monkeys. The probability of a monkey flipping heads 10 times in a row is very rare, But on average, out of 1,024 monkeys participating, one lucky monkey will flip heads 10 times in a row. No matter how small the probability of an event is, as long as the number of participants is large enough, the event is bound to happen. Eugene simply believes that people like Warren Buffett are like monkeys who have flipped heads 10 times in a row. They've been continuously lucky throughout their investment journey. The efficient market hypothesis has its own advantages and disadvantages. It doesn't provide a perfect picture of the market, but its analytical arguments are quite solid, supported by statistics on past investment fund returns. Many statistics have shown that the returns of individual participants, including both individual investors and investment funds, cannot outperform the market in the long term. This conclusion has been repeatedly tested across various periods, and the results remain unchanged. Even investment funds established with professional investment managers don't significantly differ in beating the market. These statistics are conducted in the US stock market, an extremely efficient market due to fierce competition among some of the smartest individuals in the financial investment field. Most of the world's best investors participate in the US stock market. The Vietnamese market is an emerging market and cannot be compared to the developed Western markets in terms of pricing efficiency. However, even considering the less developed nature of the Vietnamese market, beating the market remains exceedingly difficult, even for professional investors. With such stringent performance statistics almost always lagging behind the market in investment funds, legendary investor John C. Bogle introduced the concept of passive investing through index funds. If even professional investors consistently actively make investments, they consider their best ideas but still cannot beat the market. Why pay them to do so? There's no reason to pay for ignorance. If professional fund managers can't beat the market, they have no right to charge management fees from investors. Realizing this issue, John C. Bogle decided that if most individuals cannot beat the market, then achieving the market's return rate is good enough. He launched the world's first index fund, the Vanguard 500 Index Fund, a portfolio comprising 500 stocks that mimic the US S&P 500 market. The concept of passive investing through index funds is gaining increasing attention worldwide. Even Warren Buffett had to admit that John Bogle has done more for the American investor than anyone I know. A seemingly simple concept, the timing of its inception plays a crucial role in today's global capital markets. If even a professional fund manager can't beat the market in the very game they are supposed to excel at, the best a regular investor can do is invest in a market index fund and forget about their account. They don't have to painstakingly research business conditions or constantly check stock tickers, reduce listening to nonsensical advice from brokers, and still achieve quite good returns. Given the above evidence, can we conclude that Eugene Fama was right? Is beating the market impossible? Does investment skill truly exist? Or is it all merely random luck? Are outstanding investors like Warren Buffett, Ray Dalio, Howard Marks, and Charlie Munger all just lucky monkeys who have consistently flipped coin heads? As the author emphasized, the efficient market hypothesis has its own advantages and disadvantages. Advantages: it is quite accurate in describing the market's efficiency in pricing businesses. Disadvantages: it is quite accurate until it is wrong. Beating the market is not impossible, but it is nearly so. Let's return to one of Benjamin Graham's most famous quotes. In the short term, the market is a voting machine counting the votes of who is popular or not. But in the long term, it is a weighing machine assessing the true value of a business accurately. Meanwhile, Eugene Fama says, the market is always right. We can see that Benjamin Graham and Eugene Fama both agree on the long-term efficient prospects of the market. The only thing they disagree on is their opposing views in the short term. In the short term, the market can become irrational to an unbelievable extent. The market is where countless investors, with their own experiences and specialties, gather information about a company's operations and growth potential to make their own buy or sell decisions. Fierce competition in seeking profits eliminates any opportunities that just appear in the market. Practically speaking, it is quite reasonable to conclude that market prices will not stray too far from a company's intrinsic value. However, the dot-com bubble of 2001 to 2002, the financial crisis of 2008-2009, and the COVID-19 crisis of 2020 to 2021 all proved that prices can become completely irrational compared to a company's intrinsic value. Professional investors live for these moments, those rare instances when the market goes crazy. Any investor with the guts to invest in the market after such historical crash will achieve extraordinary returns in a very short period of fully deserved reward. Investing when everyone else is panicking and selling to escape is the most sensible action in investing, but it requires extraordinary psychological strength from the investor. After all, investing is more a game of psychology than a game of intellect. It's not that analytical and thinking abilities aren't important, they are very important, but a smart person can still throw their brain away and sell along with the crowd in a panic simply because everyone else is doing it. After all, it's very difficult to stand still on the dance floor when everyone around you is crazily swaying to the market's wild rhythm. However, such obvious opportunities typically appear on average once every 10 years. These horrifying crises have profound impacts on the economic and social lives of people. Clear bargains only appear after historically significant market crashes. For the most part, the market is quite reasonable in pricing. As the pilot once said, a long series of boring days intertwined with a few horrifying moments. It's no coincidence that Warren Buffett remarked that John C. Bogle has helped American investors more than any individual he knows. The idea of index fund investing is truly a revolution in investing. Beating the market is exceedingly difficult because, indeed, most of the time it does an excellent job of pricing. Therefore, simply investing according to the market is good enough. You don't have to exhaust yourself with research, reduce the depressing habit of watching stock tickers, avoid listening to nonsensical advice from brokerage managers, and still achieve quite good returns. Thus, it is better for a regular investor to invest in an index fund rather than conduct their own research and make their own investment decisions. Even Warren Buffett has provided guidance that after his passing, one should use 90% of his estate to invest in the US S&P 500 index fund. He also understands that he himself is a rare exception in the investment world. However, impossible is very different from very difficult. Beating the market is not impossible, it's simply very difficult, which is why active investing is not for most people. But that doesn't mean all outstanding investors in the world are just lucky monkeys, as Eugene Fama still claims. Their investment achievements are admirable and have been sustained long enough in the past to become reliable data. Warren Buffett and Charlie Munger of Berkshire Hathaway, Ray Dalio of Bridgewater Associates, and Howard Marks of Oaktree Capital all have their own investment philosophies that have led them to success, and they all share one common point: they do not believe in the efficient market hypothesis. In conclusion, the author wants to borrow a legal concept to summarize the article. The accused will be considered innocent until proven guilty. The accused does not have to prove their innocence because it is the default assumption. The prosecution is responsible for proving the accused's guilt. This also applies to most investors. They will be considered incapable of beating the market until there is convincing evidence to prove otherwise. The market, for the most part, operates efficiently in pricing businesses, but not always. Only a few rare investors are capable of beating the market in the long term. This is a fact that investors need to remember before participating in the market. However, we will never detect financial bubbles if we keep assuming the market is always right, thereby missing opportunities that only come a few times in a lifetime. Sometimes the market will be crazily wrong, and for professional investors, they live for these moments. Before diving deeper into the topic, there's a concept the author wants to clarify right from the start: the difference between investing and speculating. Currently, many people use the term investing broadly without truly understanding its meaning, or they might understand it, but deliberately downplay the difference. Part of this is because the term investor sounds more prestigious than speculator or trader. Another more common reason is that these individuals simply believe that participating in the stock market makes them investors. You can see this confusion everywhere. Brokers with a speculative trading style always refer to their clients as investors. Stock market articles shaping public opinion, and the lack of understanding among participants all creating a dangerous loop that maintains this illusion. Speculation is a risky activity with many uncertainties that can severely impact outcomes, but the most significant risk and danger for someone participating in the stock market is the illusion that they are investing when, in reality, they are speculating. Legendary investor Benjamin Graham once stated, "The fundamental difference between investing and speculating lies in their reaction to market fluctuations. The primary concern of a speculator is predicting and profiting from market volatility. The main work of an investor is buying and holding shares of companies at appropriate prices. The outcome for a speculator depends on their ability to predict the market, while an investor's results hinge on their ability to analyze businesses. Speculators engage in short-term transactions, whereas investors buy and hold for the long term. Speculators believe they can predict and profit from short-term market movements, while investors believe that regardless of short-term market trends, the long-term prospects of their investment portfolio remain strong. The methods the author will introduce below are all investment-oriented. Therefore, if you are looking for short-term speculative trading techniques, unfortunately, this article is not for you. The author has never believed that they have the ability to predict the market well enough to turn it into a real competitive advantage. Currently, there are 3 popular investment approaches worldwide. 1. Index fund investing. 2. Value investing. 3. Growth investing. All 3 approaches have their own advantages and disadvantages. No single approach is the best. Instead, the best approach is the one that aligns with the investor's tendencies and personality. Since these approaches embody investment philosophies, a crucial rule to follow is that investments must be held long enough for these methods to take effect. The longer the holding period, the more the investment's superiority is maximized. The investment time frame is typically measured in years, and short-term market fluctuations are often a relevant noise that should not be a concern. Passive investing, also known as index fund investing, is increasingly playing a significant role in today's capital markets due to its simplicity and accessibility for the majority of investors, with idle funds seeking better returns than traditional bank savings. Index funds are trust funds created by mimicking a specific market, so their return rates are nearly equivalent to the overall market's return rates. The Vanguard 500 Index Fund, one of the world's first index funds, mimics the S&P 500 by purchasing all 500 companies tracked by the S&P 500, naturally allocating each stock according to its market capitalization weight. Currently, the United States has index funds that mimic the Dow Jones Industrial Average (DJIA) and the Nasdaq 100, among others. Since the market capitalization of these companies is substantial and representative of the overall market, the return rates of these index funds will not significantly differ from those of broader market indices like the S&P 500 in the long term. When investors put money into these index funds, they are essentially buying a portfolio that includes some of the largest and most influential companies in the United States. Although passive investing is gaining popularity in developed Western markets, it is regrettably not as common in emerging markets like the United States compared to active investing methods. Most American investors still participate in the stock market through various active strategies. This is a mistake because, as mentioned in Part 1, most investors do not have the ability to beat the market. The reason passive investing is becoming an increasingly popular alternative to bank savings in developed countries is that its superiority over active investing is widely recognized. When investors decide to invest passively, they have 3 significant advantages over active investing. 1. Cost and tax savings. This is quite straightforward. The more trading decisions and portfolio swaps you make, the more your profits are eroded by transaction fees and taxes when selling, without being certain that those decisions are genuinely effective. These fees and taxes may seem small in the short term, but they compound over time and can significantly erode a portion of the investor's total returns. Compound interest is a double-edged sword. The author will delve deeper into this concept in Part 8-2, minimizing various investment mistakes. The more buy and sell decisions you make, the higher the chances of making mistakes. Investing has never been easy. Researching the operations of potential companies always demands a lot from investors. You can easily make mistakes if your expertise isn't deep enough or if you overlook crucial details you need to know. If finding the best companies to include in your investment portfolio is the ultimate goal of active investors, the author is confident in saying that it's no different than looking for a needle in a haystack. You might be lucky enough to find a priceless needle, but the probability is quite high that all you find is a worthless haystack. John Bogle, the father of index fund investing, once advised, instead of looking for a needle in a haystack, just buy the entire haystack. This statement reflects his ultimate wisdom. You don't need to know which company among thousands will become a superstar, just by the entire market. 3. Not time-consuming or effort-intensive. As the author mentioned in Part 1, investors don't need to spend excessive time thinking or watching depressing stock tickers daily, listening to nonsensical advice from brokerage managers while still achieving quite good returns. Looking at the chart above, we can see that there are times when the Dow Jones Industrial Average DJI outperforms the S&P 500 and vice versa. Therefore, the long-term differences are not significantly substantial, and the index fund is sufficient to provide the overall market's return in the long term. For these reasons, it is better for an average investor without much time to invest passively through index funds. By owning almost the entire market, investors can confidently enjoy nearly consistently higher returns than bank deposits without the stress of worrying too much about their investment portfolios. One of the most popular passive investment strategies is dollar cost averaging, regularly and consistently investing in the market regardless of whether it is in an uptrend or downtrend. Each month, investors allocate a small amount from their salary to invest in index funds. If the market is rising, investors buy to not miss the upward momentum. If the market is falling, investors buy at lower prices. The most crucial aspect for the strategy to be effective is discipline and time. Regardless of how the market behaves, investors need to invest regularly and be prepared to hold for a long period, typically over a year. The longer the holding period, the more effective the strategy becomes through the accumulation of compound interest. This is currently the most popular investment strategy for the majority of passive investors worldwide. Active investing is when investors independently research and design their own investment portfolios. As the author has repeatedly emphasized, only a few rare investors have the capability to beat the market in the long term, and only these individuals should participate in the market through active investing. Therefore, if you continue reading, the author believes you think you are one of the few qualified to engage in active investing. If you genuinely trust in your abilities, the author has no reason to doubt it. You might truly be one of those rare exceptions in the market. Maybe not. Time will tell. Active investing has two famous schools of thought. 1. Value investing. 2. Growth investing. To put it most simply, value investors seek to buy companies that are being sold on the market at prices lower than their intrinsic value, while growth investors look for companies whose intrinsic value will grow rapidly in the future. The value investing method was developed by legendary investor Benjamin Graham and later perfected by Warren Buffett. Warren Buffett used this method in the early days of his market participation and achieved remarkable results when he managed the Buffett Partnership before becoming the chairman of Berkshire Hathaway. For a value investor, stocks are not lottery tickets that investors frantically buy and sell on the market. Stocks represent a legal ownership stake in a company, a tangible asset with its own intrinsic value. If an investor can buy this asset below its intrinsic value, It is a wise investment action. Naturally, the more accurately an investor can estimate a company's intrinsic value, the greater their competitive advantage, and the lower the purchase price relative to intrinsic value, the safer the investment point. This raises the question, what determines a company's intrinsic value? When considering the above question, there are many factors that make a company valuable in the eyes of investors. Typical answers might include asset value, brand, financial health, growth potential, honest and competent leadership, etc. Practically speaking, all these factors play a crucial role in generating a company's future cash flows. Income and business cash flows are the primary factors that confirm a company's intrinsic value to investors. Value investing emphasizes the importance of tangible assets and quantifiable objective factors in determining a company's intrinsic value. Intangible factors like brand, company culture, talent, and long-term growth potential do not play an essential role in valuation work. For value investors, valuing a company is safer if they focus only on accurately quantifiable factors like tangible assets, cash flows, dividends, factories, land, etc., rather than intangible factors that cannot be The ultimate goal of value investing is to buy companies at bargain prices relative to their intrinsic value. If they come across a business being sold at a 30 to 50% discount on the market, they will add these companies to their potential purchase list and buy them immediately at the right time. For value investors, buying low is a wise investment. Unlike value investing, growth investing focuses on a company's future. The growth investing method was first introduced in Philip Fisher's book Common Stocks and Uncommon Profits, a renowned investor whom Warren Buffett also greatly admires. With his unique investment philosophy, Fisher made a significant impact in the investment community of his time and influenced Wall Street through his extraordinary investment achievements. In his book, Philip Fisher once remarked, "I don't want to spend my whole life chasing countless insignificant profits. I want the huge profits that I'm willing to wait for to obtain." These huge profits that Fisher refers to always come from companies with extraordinary growth potential in the market. Growth investors buy a company's stock when they believe that the intrinsic value will grow rapidly enough in the future to generate substantial investment profits. Growth investors are willing to buy stocks at high prices, even higher than the company's intrinsic value at the time of purchase, if they believe the company's growth potential is significant enough in the future. If value investors enjoy flash sales and buying bargains in the market, growth investors focus on the superstars, queens, and divas of the investment world. The ultimate goal of growth investors is to buy companies with extraordinary growth rates, and they are willing to pay premium prices to acquire these stars. The greater the growth potential, the higher the price they are willing to pay. The reason they are willing to invest heavily in these investment deals is that they believe the current price is still acceptable compared to the company's future potential. As the name suggests, what growth investors seek is never value but growth. Venture capital is the most interesting case of growth investing. Have you ever wondered why investors are still willing to pour money into startups that are continuously losing money? In 2013, when Twitter went public and became a public company, its market capitalization was $24 billion. While one of the giants in the publishing industry, the New York Times, had a market capitalization of only $2 billion. However, at that time, Twitter was continuously losing money, while the New York Times had a profit of $133 million in 2012. How could such an absurd situation occur? The answer is actually quite simple: future cash flows. Isn't Twitter losing money while the New York Times is making profits? What cash flow are we talking about here? This might sound a bit crazy, but the logic is quite simple. The quality of a company is determined by its ability to generate future business cash flows. Investors believe that Twitter's value lies not in its present, but in its future when the company grows to a significant scale, making Twitter's business cash flows easily cause envy in the leadership of the New York Times, like 16-year-old girls who have just learned to love. In other words, a company's market capitalization is the sum of all the cash flows it can generate during its existence. Future cash flows must be discounted to present value because $100 in the future will always be worth less than $100 today. When viewed through the lens of future business cash flows, we can easily see the stark difference in the quality of rapidly growing companies like Twitter compared to slowly growing companies like the New York Times. The difference will compound over time, creating an almost unbridgeable gap, thereby generating an almost monopolistic competitive environment between a giant in the industry and the remaining small players. The growth of companies like Google, Facebook, and Amazon follows this basic pattern. Simply put, value investors seek companies being sold at prices significantly lower than their intrinsic value and will sell for a profit when the discounted price returns to intrinsic value. The market will soon or later recognize its mistake and quickly correct it. Unlike value investing, growth investors look for opportunities in companies with the potential for rapid intrinsic value growth to generate significant investment profits in the future. With the above information, many analysts have concluded that value investing focuses solely on the present, while growth investing only cares about the future. One side only cares about the intrinsic value at the current moment, while the other only thinks about the intrinsic value in the future. However, is this difference truly accurate? Is the distinction between value investing and growth investing as important as many people still think? The evolution of Warren Buffett's investment style. The value investing school, widely known, is also the time when Warren Buffett's fame in the investment community began to rise during his early days managing the Buffett partnership. As a student of Benjamin Graham, he internalized the essential principles of value investing. In an era when the internet was not yet prevalent and public company information was not as easily accessible it is today, Warren Buffett spent countless hours reading the thick pages of Moody's manual to find financial information about various companies. He bought many businesses at market prices significantly lower than their liquidation value, the amount of money a company has left after selling all its assets and paying off all outstanding debts. He could buy so cheaply simply because, at that time, no one was paying attention to such companies. He was highly successful with this strategy, digging through thousands of pages of Moody's manual to find hidden bargains that no one else wanted to read. He humorously described this investment method as buying a dollar for 50 cents. With outstanding performance managing the Buffett partnership, it is no surprise that he became very confident in the value investing strategy till he managed Berkshire Hathaway alongside Charlie Munger. If the author were to give a personal opinion on the most influential figure in Warren Buffett's investment career, it wouldn't be Benjamin Graham but Charlie Munger. Munger successfully convinced Warren Buffett to shift from hunting bargains in the market to becoming the owner of great companies. Do you remember Warren Buffett's famous saying, "It's better to buy a wonderful company at a fair price than a fair company at a wonderful price"? That's all Charlie Munger. Value investing helped Warren Buffett earn a significant amount of money while managing the Buffett partnership, but with the enormous capital when managing Berkshire Hathaway, he began investing in great growth companies like Coca-Cola, American Express, and most recently, Apple. There are many reasons to explain Warren Buffett's shift in investment style, but for the author, the most important reason is simple: he understands the power of compound interest and wants to fully leverage this power. He couldn't do this with Benjamin Graham's investment method. For Warren Buffett, as long as the company he holds still has growth potential, he will never think about liquidating his investment portfolio, regardless of how the market prices his holdings. This is a crucial difference from the method he once used. While managing the Buffett partnership, he would buy businesses priced significantly below their intrinsic value and sell for profits when the market price reverted to intrinsic value. With the help of Charlie Munger, he began searching for truly quality companies with long-term growth potential, willing to pay premium prices for these stars, which would make his mentor Benjamin Graham cry out of frustration. He then simply held his investment portfolio despite market fluctuations. Einstein once said, "Compound interest is the eighth wonder of the world." In reality, there is no polite record confirming that Einstein ever said this, but this once again confirms the power of compound interest. Although he passed away long ago, Einstein continues to receive interest by becoming the accidental author of famous sayings he never actually made. Perhaps we shouldn't be too surprised those who understand the allocation of compound interest, the 80-20th rule or Pareto principle, see that as small number of brilliant individuals like Einstein or Mark Twain will always receive the majority of credit for the world's best sayings, whether they actually said them or not. Perhaps Einstein never said that, but compound interest truly is the eighth wonder of the world. With the power of compound interest, Warren Buffett has become one of the richest people in the world. Over 80% of Warren Buffett's net worth was accumulated after he turned 60. To achieve his current success, patience in holding investments is the most crucial key in his investment strategy. As long as the company still has growth potential, he will never consider liquidating his holdings. He understands that as long as he holds his investment portfolio, compound interest continues to serve his interests through the company's growth. As of now, he still holds 400 million shares of Coca-Cola, which he began buying in 1988 for a total of $1.3 billion. The value of this investment was recorded as $20.7 billion in 2019, with book profits of $19.4 billion, not including the annual dividends paid by Coca-Cola. Never underestimate the power of compound interest. Many people still think Warren Buffett is a value investor because this school of thought made his name famous. This might be true when he was managing the Buffett Partnership, but currently, Warren Buffett's investment style has evolved to a level beyond what his teacher Benjamin Graham could have imagined. He hasn't entirely abandoned the value investing philosophy. In fact, he still applies many old rules whenever considering new investments. He simply developed an investment style that better suits himself or superior method when managing the enormous capital of Berkshire Hathaway. If Warren Buffett had strictly distinguished between value investing and growth investing, he would never have achieved the enormous success he enjoys today. He was someone who initially had no understanding of technology and didn't like investing in fast-growing tech companies. If he had continued thinking in this old-fashioned way, he would never have changed his perspective and decided to allocate a massive amount of Berkshire Hathaway's capital to Apple. It's not surprising that Apple, although invested in for a relatively short period, is one of the most profitable investments for the conglomerate. Value investing or growth investing should simply be understood as investing. Any method that helps you make wiser investment decisions should be welcomed. As a famous saying in the business world goes, if your only tool is a hammer, every problem looks like a nail. To think more effectively, investors need to diversify their own toolbox, never thinking in a one-dimensional way, and develop their own investment philosophy that aligns with their personality and capabilities. Investment risks, navigating the uncertainty of the market. Investment activities always come with risks, much like the two sides of a coin. Whenever you consider a particular investment, sooner or later, you must think about the risks associated with it. Investors design their own portfolios, hoping that their personal assessments of a company's quality will be recognized by the market in the future. However, no one possesses the ability to predict the future with precision. The future is entirely uncertain, but investment is intrinsically linked to it, like a shadow to its form. Learning to face the uncertainty of the future is essentially learning how to control investment risks. To become a smart investor, risk management is an essential skill. The illusion of skill in an uptrend. During an uptrend, any lucky fool can appear to be a genius. It's incredibly difficult to distinguish skill from innate foolishness when the market is soaring on the back of an exuberant bull. When the market is rising, every investment seems profitable. The easiest way to increase profits under the strong influence of greed is to take on more risks. Increasing margin leverage becomes the default style for most novice investors borrowing money you might not be able to repay in the future to bet everything on the market. After all, it's very hard to stay idle while others are getting rich quickly with full margin strategies. Only when the tide goes out do you discover who has been swimming naked. Warren Buffett often jokes about the market's frenzied excitement. Unfortunately, most investors, fueled by continuous greed during uptrends, end up learning the painful lesson that market crash plus full margin equals account blow-up. Risk is always an essential part of the market. Every decision an investor makes carries inherent risks. You can never achieve long-term success in the market without knowing how to manage investment risks. The market is ruthless, don't be the ones left bare. When the tide goes out, the academic illusion. If you've ever studied finance or economics, risk is defined by the beta index, a fancy term for the volatility level of a particular stock compared to the overall market. Risk is measured by the past price fluctuations of that stock relative to the market. By this logic, if a stock's price plummets after a downturn, it is considered riskier if its price remains around the previous level. Buying a stock that has dropped sharply after a significant decline carries more risk for the investor compared to buying the same stock at its previous price level. Yes, you read that right. The academic logic behind the beta index suggests that buying cheap is riskier than buying expensive. This is the nonsense that business schools and finance programs teach their students every year. Entire theories about portfolio construction and optimal capital allocation methods are built on the foundation of beta, the index of a stock's past price volatility. Economics and finance students spend considerable amounts of money learning these irrelevant theories, completely detached from reality, while professors continue to preach them absolute truths. Countless famous investors around the world have criticized the academic concept of beta as entirely unrealistic. For them, the real risk investors face has never been the price volatility of stocks. Therefore, most of what professors teach at universities lacks practical applicability in investing. It's like teaching a fish how to swim. No matter how fast the fish swims, the fish still needs to learn. The origin of the academic illusion. To understand why this delusion has persisted for so long, we should look back to the origins of modern economics. Adam Smith. In his famous book The Wealth of Nations, Adam Smith's profound thoughts laid a solid foundation upon which his successors gradually built the colossal house of economics we know today. With his widespread influence, many mistakenly consider him a pure economist. However, Adam Smith never truly saw himself as a pure economist. He always took pride in introducing himself as a philosopher. If you've read The Wealth of Nations you will never find a single mathematical formula or economic chart written by Adam Smith, a reality completely contrary to today's basic economics textbooks. In what is considered the cornerstone of economics, all you encounter are profound philosophical arguments about how the social economy operates. For him, economics was a socio-political discipline, a small branch intersecting sociology and political science. Adam Smith's economics viewed the interactions between individuals as essential to the functioning of a market economy. The pursuit of scientific economics, until his disciples emerged with ideas that forever changed the field of economics, the natural development of mathematics, and the remarkable success of classical physics, especially the towering status of Isaac Newton after publishing Philosophiae Naturalis Principia Mathematica which introduced Newton's 3 famous laws, caused a significant impact on the intellectual community of that time. It's no exaggeration to say that during the early days of economics as a discipline, physics had become the king of the sciences, with Newton sitting on a throne of immense power. The generations following Adam Smith dreamed of a day when economics would be recognized as a mainstream scientific discipline, hoping that one day an economist would take over the throne Newton left behind. It was a dreamy illusion, but a beautiful one. And so began the scientific race to formalize the field of economics. The great success of physics stemmed from the absolute predictive accuracy of theoretical models describing natural laws governing the universe. This extraordinary success could not have been achieved without the robust support of mathematics. The mathematical precision and the predictive capabilities of theoretical models became the ultimate weapon that made Newtonian classical physics the king of the sciences. With its high status and prestige, it's no surprise that physics created an aura that could blind those aspiring for similar status. Aspiring to transform economics into a mainstream scientific discipline, Adam Smith's disciples felt compelled to mathematize their field. They yearned for the absolute precision of mathematics, theoretical models resembling scientific rigor, and the reputation that a scientific professor could attain. In their blind pursuit, they forgot one basic thing. Economics is a socio-political discipline because it focuses on solving problems related to human behavior in the economic market. And humans are always emotional beings. Modern economics, mathematical complexities detached from reality. Today's basic economics and finance textbooks are filled with advanced mathematical equations, theoretical models with unrealistic assumptions, probability graphs, and more. All these mathematical tools have been added over time with the aim of turning economics into a mainstream scientific discipline. Economists after Adam Smith have always aspired for their field to hold the same status as modern physics or biology mainstream scientific disciplines. However, no matter how hard they try, economics will never be a true science. The predictive power of economic models will never be reliable simply because humans will always behave emotionally. The beta index itself is just one of the various attempts by economists to model the highly emotional interactions between people. Volatility is defined as risk in the field of finance because it can be measured accurately and thus used in calculations and modern financial theories. A theoretical model doesn't need to be practically applicable as long as it meets the strict criteria of science. It's no surprise that the practical application of theory has had to give way to mathematical elegance and scientific prestige. No famous investor in the world acknowledges the validity of the beta index in determining investment risk. This illusion has persisted for so long in academia because they are trying to model something that cannot be scientifically modeled: the behavior of humans. As the renowned physicist Richard Feynman once remarked, imagine how difficult physics would be if electrons had feelings. If one day electrons suddenly had emotions for no reason, physics would no longer be a science, it would become sociology. Rethinking risk. Beyond market volatility, in rational risk thinking, what we want to understand are those situations that keep investors up at night, unfortunate events that might occur and cause investors to lose sleep. Most investors are not worried about market volatility. What they truly fear is the inability to recover their capital. This is the risk that investors are concerned about. How should we understand risk? The inability to recover capital is entirely different from market volatility. A significant market drop won't be a big problem for investors if they trust their initial analysis and hold on until the market recovers. In a sharp decline, the possibility of loss can occur for two main reasons. The investor cannot stay calm during the market adjustment and decides to sell off their portfolio to cut losses. The investment cannot recover due to the fundamental factors of the company. Of course, defining risk as the inability to recover capital has its own drawbacks. It cannot be measured as accurately as market volatility, and if it cannot be measured scientifically, it's useless for the theoretical models presented in the field of finance. However, Warren Buffett once commented, "Better to be approximately right than precisely wrong." Some things in the world simply cannot be scientifically modeled, and we must learn to accept this truth when facing risk. The accuracy that mathematics provides is meaningless if the models are built on an unrealistic foundation from the start. You can build a magnificent castle, but if its foundation is not solid, your construction is nothing more than a sandcastle. Sooner or later, it will collapse. A practical example of risk: imagine you invest $100 today, and a year later you have $200. Does this investment carry a lot of risk? Amateur investors might say no because, for them, profitable investments are never wrong. Economics professors, on the other hand, might say yes because the only way to achieve a 100% return in 1 year is to make a highly risky investment decision. However, a smart investor won't rush to answer. To them, this deal could either be a safe investment with the promise of excellent returns after financial bubbles burst, or a foolish, risky investment that happens to be lucky betting on companies continuously hitting new highs and being lucky enough not to face a downturn. The important thing investors need to remember is that even if an investment was profitable and closed with a gain, there's no way to truly know it was a smart decision because risk is always lurking throughout the entire process. A profitable investment does not mean it was a wise decision, and vice versa. It all depends on the question: how much risk did the investor accept to achieve that level of profit? Every decision carries risk. In investing, every decision carries inherent risks. As the author explained, investment risk should be understood as the possibility of not being able to recover your capital. Therefore, any investment decision, no matter how strong the supporting arguments are, must face the risk of loss. The difference between professional investors and amateurs is that professional investors always recognize this risk and know how to minimize it to the fullest, while amateurs always have the mindset, as long as the investment is profitable, I'm right. An important concept the author wants to emphasize here is that the outcome of an investment is not an accurate measure of investment skill. A profitable investment can still be a foolish decision, and a losing investment can still be a correct decision, all depending on the correlation between potential returns and the corresponding level of risk involved in each investment decision. The role of luck in investing. In investing, luck plays a decisive role in the final outcome, but is never the most important factor. You might make the right decision, but luck might not smile on you, resulting in an investment that doesn't meet your expectations. For someone inexperienced, that decision might seem foolish because it didn't yield profits, at least in the short term. Similarly, any lucky fool who catches the right wave in the market looks like Warren Buffett to the uninformed. Whatever he says sounds like the truth, at least to those who lack understanding. Avoiding the pitfalls of greed and over-leverage. Accepting additional risk to increase profits has never been a wise investment action. Any fool can do it. All you need to do is go full margin and pray for the best. Investment skill requires much more than that. Nassim Taleb, in his book Fooled by Randomness *, described these lucky fools in the market as follows. When the market is going up, the best results often come from those who dare to take the most risks. Are they truly intelligent for having predicted the uptrend and decided to increase leverage to maximize profits? Or are they simply reckless speculators like gamblers who were lucky to catch a booming market? The challenge of identifying true skill. In the short term, especially when the market is rising, it is very difficult to distinguish between skilled investors and lucky fools because everyone is enjoying profitable investments. Most people are busy savoring the beautiful moments and forget a basic principle: nothing lasts forever. Every party must end, every market wave must come to a conclusion, and as Warren Buffett often warns, only when the tide goes out do you discover who has been swimming naked. Understanding what causes capital loss. If risk is the possibility of not being able to recover capital, what factors in the market cause this possibility to arise? A common factor always associated with risk is price level. A market trading at high prices always comes with high risk, and vice versa. The more frenzied trading and chasing of stocks at high market prices, the greater the chance of not being able to recover capital. As explained earlier, market volatility isn't a big issue. The investor can hold on until the market recovers, provided they have thoroughly researched the company's potential and their purchase price is reasonable compared to its intrinsic value. There are two main reasons why capital loss can occur during market volatility. 1. The investor decides to sell their portfolio due to an inability to maintain composure, thus missing out on the market's recovery momentum. 2. The market recovers, but your portfolio doesn't because of fundamental factors. The investor simply bought at prices too high relative to the company's intrinsic value, a move we still often call buying at the peak. High prices and increased risk. Therefore, we can conclude that high prices are one of the most critical factors constituting risk in the market. The higher the market price at which investors participate, the greater the possibility of loss. The more excited the market is, the more dangerous it becomes for the investor's capital, and vice versa. Countless times, I've witnessed and experienced young investors enthusiastically entering the market during the final wave and watching their accounts evaporate quickly. The previous excitement swiftly turns into extreme fear, accompanied by baseless complaints like, "Stocks are no different from gambling." The market reflects the participants' intentions. Absolutely, it will be like a legal casino if you act like a gambler, and like a great place to build wealth if you act like a smart investor. Participating in the market without basic knowledge and not knowing what you're doing is akin to gambling. The timeless wisdom of Alexander Pope. Alexander Pope once mused, "Fools rush in where angels fear to tread." Although the stock market wasn't invented in Alexander Pope's time, his insightful view on the greedy nature of fools and the cautious instincts of angels will always remain relevant. Entering the market during the final wave driven by FOMO, fear of missing out, will always be a timeless reason why investors lose money. It's incredibly hard to control yourself when everyone around you is getting rich quickly. However, countless fortunes have been lost simply because of the desire to get rich quickly. Practically speaking, the more emotional your investment decisions, the greater the risk of not being able to recover your capital. Successful long-term investing leaves no room for emotions. The misconception of past performance. Most investors participating in the market expect the future to mirror the past, thereby underestimating the market's ability to change behavior unexpectedly. If the market is soaring, they expect this to continue indefinitely. If the market is plummeting, they believe no price drop is too low for them to feel comfortable investing again. Risk management seems meaningless when you have continuously profited from a series of bold and reckless investment decisions in the past. However, risk management is like insurance for your home burning down. It might seem like a foolish decision to pay for insurance when everything is fine and you're sitting comfortably in your living room watching TV with your family. Why pay for home insurance when everything is going smoothly? The answer is that only when you're standing in front of a burning house will you truly appreciate the value of the insurance you've been paying for all year. Insurance only clearly demonstrates its value when bad things happen, and the worst things always happen in the market regularly. Risk management, the key to long-term success. When commenting on the factors of long-term success in the market, famous investor Howard Marks concluded, "The most important thing is to remember that you don't have to make your best investment decision every day. The main job of an investor is to accept risk intelligently in the quest for profit. Doing this well is what separates the best from the rest of the investment community." The concept of high risk, high return is popular among investors. At first glance, it sounds like a truth, but the best investors never actually pursue it. What they truly seek is low risk, high return. Even in the highly risky field of venture capital, the guiding principle is never high risk, high return, but rather high risk, moonshot returns. Avoiding the trap of leverage, accepting additional risk to increase profits is too easy. Any investor can do it by increasing leverage and hoping for divine intervention. But as previously emphasized, terrible things happen in the market regularly. Margin leverage is a double-edged sword. It merely amplifies the results you're achieving. If you're profiting, it amplifies those results. If you're losing, it increases the losses correspondingly. Simply put, achieving high returns with high corresponding risks does not demonstrate your investment skills. A smart investor only accepts risks wisely in their pursuit of profit. For a given level of risk, they always require the potential return to meet their stringent criteria before making an investment decision. If this criterion isn't met, they simply refuse to participate. Surviving the ruthless market, smart investors understand that the market is a very ruthless place. Sooner or later, the most catastrophic events will occur. To survive long-term in a harsh market, risk management is a must. However, risk management is one of the most overlooked skills in investing, especially during uptrends. The reason is that as long as the market is performing well, the possibility of not recovering capital won't materialize. Losses losing the ability to recover capital only occur when risk is actualized through negative market movements. One crucial thing investors need to remember is that a profitable portfolio in the past doesn't mean there was no risk throughout that period. Just because the market has performed well in the past doesn't mean that risk management is meaningless. It simply means there was no slippery ground at that time. However, that doesn't mean it will never be necessary in the future. Just like a single house fire is enough to make you truly appreciate the value of your annual insurance premiums, investing is similar. You only need one major market downturn to truly understand the importance of risk management throughout the entire investment process. Anyone who neglects this has already been mercilessly eliminated by the market. The market is ruthless. The essential skill of risk management. Although risk management plays an extremely important role in investing, it remains an underemphasized skill. The reason is that throughout the market's existence, good times always outweigh the dark times. When a prolonged period of prosperity continues, most people forget the horrific moments they once experienced in the market and believe it will never return. During uptrends, it's very difficult for investors to control themselves and refuse to increase leverage or chase stocks to maximize investment profits. The fear of missing out FOMO is too strong to resist. Once again, investing and risk are always two sides of the same coin. You cannot completely avoid risk once you decide to participate in investing. Risk is always an essential part of the game. However, you can always outperform others by only participating when the potential return relative to the corresponding risk meets the stringent criteria you've set. Profitable investing during good market times is incredibly simple. Anyone can close their eyes and shoot arrows, but still hit the bullseye. Practically speaking, profits don't tell us much about individual investment skills. During uptrends, only seasoned investors can look at a profitable portfolio and recognize whether it contains significant risks. Always remember that just because your portfolio hasn't exploded like a nuclear bomb in the past doesn't mean you've made the right decisions. Risks might have always been lurking in the investor's portfolio, waiting to be realized as losses through negative market movements. Enduring market downturns with risk control. The market will always go through horrifying collapses. Beautiful periods cannot last forever. It is during these darkest market phases that risk management truly shines. Therefore, the path to long-term investment success cannot be achieved without a rigorous risk management process. Mastery of risk management is the essential ingredient that makes a legendary investor. Once again, borrowing Howard Marks' wise words to conclude, the most important thing is to remember that you don't have to make your best investment decision every day. The job of an investor is to accept risk intelligently in the quest for profit. Doing this well is what separates the best from the rest of the investment community. No investor in the world can convey fundamental investment concepts as profoundly as Warren Buffett. Whenever I begin a new section in my investment series, Warren Buffett's annual letters to Berkshire Hathaway shareholders are always the first materials I turn to. When discussing the topic of margin leverage in investing, it would be a significant oversight not to mention his famous quote, "When the tide goes out, you can see who's been swimming naked." Investors who swim without a life jacket are no different from those who, in a state of euphoria, continuously increase their margin leverage during an uptrend. As the wave grows higher, increasing margin gives investors the feeling of being on top of the wave, believing that everything they do is correct and that wherever they place their money will yield profits. It's hard not to feel great when you're consistently making money during a rising market by maximizing margin usage, feeling as though everything in the universe is happening according to your will, a truly exhilarating sensation. Until the time bomb detonates. For those who use margin leverage crazily to maximize profits, a market crash is the worst nightmare imaginable. The interest they earned during the uptrend suddenly evaporates in an instant. Previous euphoria quickly turns into extreme fear, and the tool they confidently used to maximize profits in the past suddenly backfires dramatically. As the legendary saying in the stock market goes, a level 0 investor becomes level 1 when they survive their first market crash. Investors swimming without protection have already drowned. The double-edged sword: most inexperienced investors have a misunderstanding about margin. One common misconception that has persisted for a long time has the illusion that margin is a financial tool used to maximize profits. Suppose you have $100. If you invest only this amount with a 20% return, you'll make a $20 profit. However, if you borrow an additional $200 to invest with the same return rate, your profit increases to $60. Even without completing third-grade math, you understand that a $60 profit is much more attractive. This is the bait and switch argument that brokerage managers often use to encourage novice investors to increase their margin ratio in their portfolios. Everyone wants to make more money, and after all, we are only human. Greed easily overpowers reason. To understand it correctly, margin is not a tool for maximizing profits. It simply magnifies the results that the investor is already achieving. If you're making a profit, it amplifies the amount of profit. If you're losing, it amplifies the losses accordingly. In the grand casinos of Las Vegas, gamblers still tell each other, the bigger your bet, the more you win when you win. Of course, no one thinks they'll lose when betting, but I always wonder why they don't complete the saying with, you'll also lose more when you lose. In reality, margin leverage is simply a tool for investors to put more money into the market, and the most important thing to remember is that this money isn't yours. You're borrowing money that you can't repay in the future if things don't go as planned. For seasoned investors, surprises in the market are always a constant. Borrowing money you can't repay in the future just to earn extra profits you don't really need in life is the most unwise action in investing. Even if your portfolio isn't immediately affected by market fluctuations, I'm certain that margin loans will always be an everlasting nightmare in your life. You glance at the daily ticker with exhaustion, aiming to escape the market as soon as possible if volatility occurs, because you know you're fully margined. Every night, you lie awake, restless with fear that the market will crash tomorrow while you're fully margined. You go on dates with your loved one, but all you can think about is your fully margined portfolio. Your partner gets angry at your neglect, leading to arguments and eventually a breakup. You don't care much because your portfolio is fully margined, and tomorrow hasn't come yet. The only thing worse than a nightmare is an endless nightmare. In reality, the minds of those with high margin leverage will never achieve peace of mind. Even if their investment portfolios aren't immediately affected by short-term market fluctuations, the relentless worrying will always linger in their minds like an unending nightmare. A brain filled with fear can never make sound investment decisions. When deciding to invest, everyone hopes to achieve a stronger financial position in the future. A stable financial position will provide peace of mind when contemplating an uncertain future. The stronger your finances, the easier it is to handle unexpected events that the future may bring. Therefore, using margin fundamentally contradicts the basic purpose of investing. You desire peace of mind, but what you gain is always extreme fear. Even if your portfolio is profitable, you still don't feel comfortable because your mind is surrounded by countless worries about potential negative market developments in the future. Take a simple example to understand the danger of investing with high leverage. Suppose you have $100,000 in cash, borrow an additional $400,000, and invest a total of $500,000 in the market. Your total assets amount to $500,000, including $400,000 in borrowed money and $100,000 in equity. The market undergoes a severe downturn, and your account drops by 30%. Now, your equity is wiped out and even becomes negative by $50,000, making your total assets $350,000, including $400,000 in borrowed money and a negative $50,000 in equity. you suddenly realize that your own capital has evaporated in an instant and all the assets you have come from borrowed money. Sooner or later, you'll have to repay everything straightforwardly to the creditors. Greed is always one of the fundamental human instincts. Learning to control greed will always be one of the most challenging tasks for investors, especially inexperienced ones. I know that many have become wealthy by investing with huge borrowed amounts, but that's also the fastest path to financial disaster for many other investors. No one wants to get rich slowly, so increasing margin leverage is a default style for those participating in the stock market with the desire to get rich quickly. To these individuals, the stock market is seen as a legal casino, and the reason they come there is to gamble. The market reflects the mindset of its participants absolutely. The moment participants start behaving like gamblers is when they begin handing over the hard-earned capital to the market house. If you see the market as a casino, you must also accept the obvious truth that the house always wins in gambling. Leverage may have taken some investors to the clouds of paradise, but it has also trampled countless investors into dark abysses with no way out. Market crash plus full margin equals account wipeout. Increasing margin leverage to maximize profits has never been a decision that demonstrates investment skill. Margin is simply a tool for investors to place more money on the table, thereby magnifying the results you'll achieve. It doesn't change the fundamental nature of investment decisions. Using margin doesn't turn a foolish decision into a smart one, and vice versa. Therefore, a common misconception in the investment community is that the additional profits you earn from margin reflect your personal investment skills. To understand it correctly, investment skills are demonstrated through intelligent investment decision-making processes. Using margin is merely a method to amplify profits if the decision is right and, of course, amplify losses if the decision is foolish. But it doesn't add any value throughout the investment decision-making process. From my personal experience, those who use margin often suffer painful losses more than using it as a weapon to conquer the market. In addition to magnifying profits and losses in investing, leverage also brings another extremely dangerous risk that has no potential profit prospects to compensate the risk of account wipeout. In his famous book The Black Swan, Nassim Taleb stated, "If the probability of a financial catastrophe is greater than zero, all cost-benefit analyses are meaningless." In other words, the risk of being wiped out from the market is too great to accept, no matter how promising the profit prospects may be. This is an important lesson that investors need to remember to survive long-term in the market. When inexperienced investors use high margin ratios, the risk of having their accounts wiped out through a margin call is always present throughout the investment process. Once significant volatility occurs, all the accumulated profits can vanish in an instant. Leverage, a useful tool to maximize profits, suddenly turns into a terrifying self-destructive weapon, and at this moment, Warren Buffett's wisdom is once again evident in his saying, "To win in the investment game, you first have to survive." Always ensure that your investment portfolio can survive in any situation, even the worst storm you can imagine. When an investor starts using margin leverage in their investments, they gradually become accustomed to the exhilarating rush that margin can bring. As a deeply ingrained habit through countless practices, they will always turn up the margin whenever making a new trade. Using margin in investing is an addictive action, one of the most dangerous habits in investing. In the long term, severe recessions occur less frequently compared to the good months in the market. The longer the peaceful period lasts, the more investors believe that the dark times will never return. Therefore, the most prudent thing they can do is to increase their margin ratio to maximize profits. This will continue until the market suddenly changes its behavior, causing horrifying experiences for inexperienced investors who are not ready to abandon the necessary risk control processes to survive long-term in the market. Nassim Taleb perfectly described this process in his book Fooled by Randomness. The reality is far more terrifying than a game of Russian roulette. First, the killing bullet will not be fired frequently, like a revolver with hundreds or even thousands of chambers instead of just 6. After a few trials, the investor starts to forget about the existence of the bullet, a false sense of security. When the bullet is fired by the market, investors using high leverage will always be the first victims. Most of these individuals will face margin calls, and if they cannot deposit additional funds into their accounts, brokerage firms will forcefully sell their investment positions, even though the market prices are extremely unfavorable at that moment. Buying high and selling low has never been a successful formula in the market. However, every time a margin call occurs, brokerage firms always prioritize recovering margin loans as quickly as possible over the individual investor's emotions. This creates an extremely dangerous loop where the first margin calls trigger subsequent margin calls, creating a chain reaction during a crisis. To invest successfully in the long term, all the world's famous investors understand that survival skills are always more important than the ability to maximize profits. As long as you continue to participate in the game, new opportunities will always arise. Once you're kicked out of the market, no opportunities will be presented to you. You're officially out of the game. Margin is just a tool. The problem always lies with us. To understand it most correctly, margin itself is not inherently bad. It is simply a tool in financial investing. The problem always lies with the user. We are simply too emotional creatures to use margin wisely. The 2008 to 2009 financial bubble burst is a clear testament to the horrific damage caused by foolishly using leverage. The aftermath still lingers today, with central banks around the world continuously printing money annually to support the global economy's recovery. The sudden emergence of the COVID-19 pandemic was a cyber attack on the already fragile global economy following the 2008 crisis. As Nassim Taleb warned in Fooled by Randomness, no one values their life and yet accepts to play a game of Russian roulette no matter how enticing the rewards are. Similarly, highly leveraged investors might be unknowingly participating in the market's Russian roulette game. Instead of the standard revolver with only 6 chambers, the market's chamber could have thousands, creating a false sense of security after a few lucky survivals. Just because you've been lucky enough to survive past attempts doesn't mean this will continue in the future. Using margin aggressively during a booming market and thinking it's a great way to profit is no different from being lucky enough to survive the first Russian roulette trial and thinking it's a smart idea to continue making money in the future. A short-sighted thought. The existence of the bullet is something intelligent investors must never forget. Your survival depends entirely on it. However, the prolonged beautiful period in the market always makes the majority of investors forget the dangerous existence of the bullet. Most investors think they can safely use margin by exiting before the market experiences a downturn. This is an extremely naive thought when investors believe they can safely sell highly leveraged positions. How many people think this way like you? The answer is almost everyone using margin. Everyone tells themselves that as long as the market shows a few bad signs, they will execute sell orders for their entire portfolio immediately. As more and more investors rush to sell to escape, the negative reaction creates a dangerous feedback loop that reinforces panic in the market. This is also why during an uptrend, the curve rises, but during a downtrend, it plummets straight down, free falling. All highly leveraged investors believe they can escape safely without realizing that this is not an exception unique to them. It's similar to watching a movie where a fire breaks out, but there's only one emergency exit. It's no surprise that everyone rushes to the narrow door to escape. It may take a considerable amount of time for the bubble to inflate, but deflating it is no small feat. In summary, using leverage wisely is not even easy for professional investors. A fully margined account will always bring fear to the investor, negatively affecting the decision-making process. Therefore, my advice to inexperienced investors is stay away from margin trading if you don't know what you're doing. Account wipeouts are no joke, and I don't want you to experience this terrifying feeling like many other inexperienced investors. The cost of this lesson is simply too high. In investment, few things are certain about the future. In investment, there are very few things that investors can be certain about regarding the future. The uncertainty of the market's future will always be a constant that never changes. Confidence can be a good quality in other fields, but unfortunately, it often buries countless inexperienced investors who are overly confident in themselves. For seasoned investors, the almost insane confidence of new investors always feels intriguing. It reminds them of the early days when they themselves were just beginning to participate in the stock market. They too once felt the thrill of adventure until the market, like a strict principle, administered rigorous tests. In investment, as in life, there are very few things we can be completely certain of. Success never has a shortcut, beating the market has no formula, and nothing lasts forever. However, if the author had to identify a market variable that we can confidently assert as unchanging, it would be the cyclical nature of the market. As the renowned investor Howard Marks once remarked in his book, "The most important thing, the more time I spend in the investment world, the more I appreciate the value of cycles in the market. When the market rises to high, it inevitably must fall. When it falls to low, it must recover." In other words, the market moves like a pendulum, and when the pendulum swings in one direction for long enough, it generates enough momentum for a reversal. To opposite extremes, the existence of cycles in the market is fundamentally due to the presence of emotions in investing. In fields where emotions do not exist, confidence in the certainty of the future is entirely justified. For example, mechanical machines always operate predictably if we understand their operating principles. However, in any field where humans play a crucial role, results are always diverse and cyclical, or in other words, unpredictable. We have never been purely rational beings, despite what economics often assumes. The market is essentially a marketplace, a gathering of buyers and sellers conducting transactions with one another. It can be said that the market's fluctuations from peak to trough are driven by two completely opposing emotions, greed and fear. Greed and fear change rapidly, entirely dependent on investors' expectations for the future. A bright future outlook is the perfect catalyst for greedy behavior, while a bleak future scenario is the perfect breeding ground for fear to dominate. Just like a marketplace, a company's stock price will increase when demand exceeds supply. The number of buyers will continue to rise as more people believe in the company's bright future prospects. This will continue until expectations no longer match reality, and bubbles always form when there is a gap between expectations and reality. Bubbles will continue to inflate as more investors become confused between illusion and reality. Eventually, the inevitable will happen. When the time bomb explodes, the market will plummet with a common expectation of a disastrous future. Of course, this explanation leaves out many important specific details, but overall, it fully illustrates the main points of the market's cyclical fluctuations. In other words, the market moves like a pendulum, with movements toward extremes, providing the impetus for the market to swing back. The upward movement toward the peak generates increasing momentum for the market to collapse, and the downward movement toward the trough generates increasing momentum for the market to recover. The cyclical nature of the market is unchanging, as history has always proven. Nothing lasts forever. In the famous series Game of Thrones, there is a scene where Jon Snow and Daenerys Targaryen are walking together at Winterfell, while atop the walls, Davos, Varys, and Tyrion engage in an interesting conversation about their powerful queen. Tyrion, they make a lovely couple, don't they? Varys, you're overestimating our influence. Jon and Daenerys don't want to hear advice from old men. Tyrion, I'm not that old, and our queen highly respects the wisdom that comes with age. Varys, of course. Respect is how the younger generation keeps their distance from us, which is why we don't want to remind them of a harsh truth. Tyrion, what is that truth? Varys, nothing lasts forever. Varys understands that nothing certain exists in life, just as Jon and Daenerys' feelings for each other may not last forever. Therefore, a general rule of life is that nothing can last forever, and the trends in the stock market are no exception. Companies that perform well during good economic times will decide to heavily invest in production capacity to capitalize on growth trends. These investments become cost burdens that hinder the business when the economy declines. Banks will expand lending frequency with attractive interest rates, even lending to customers with unreliable credit scores during economic growth, and then become extremely cautious with loans when the economy worsens. Investors during market booms will always overvalue companies, while investors during market crises will always undervalue companies. An endless loop of economic cycles. In the market, nothing develops as steadily as a straight line in a mathematical graph. Everything develops steadily for a while, then collapses, after which everything becomes a disaster in an instant. Prolonged disasters cause most people to forget that a turnaround always follows a storm. An economic newspaper once published a famous headline stating, "The worst bad loans always come during the best economic times." Similarly, the riskiest investments always occur during the most euphoric market phases. The economy will always expand and contract in an intertwined manner as consumer buying behaviors are entirely driven by emotions. Therefore, no economic trend can continue indefinitely without an endpoint. Echoing the famous economic saying, "What can't last forever will eventually come to an end." However, every decade, a group of new generation investors decide that the cyclical nature of the market is an outdated concept. They believe that a bright future outlook will last forever, or a bleak future scenario will have no end. When a trend continues long enough, it creates the illusion that this trend will persist indefinitely. But history has proven that the market always bursts when good times last long enough, such as the 2000 tech bubble and the 2008 financial bubble, and always recovers when dark times must end. The recovery period from 2001 to 2000 for after the tech bubble burst, followed by the formation of the 2008 financial bubble, and then the market's impressive recovery post-2009. Investors can confidently predict that when the market rises too long, it will eventually have to fall, and when a nightmare scenario persists long enough, a turnaround will appear. However, the timing and intensity of these reversals are impossible to predict. Experienced investors who understand financial history always know that cycles will occur, and they also know that investment opportunities become increasingly attractive as more people overlook this important concept. But they are wise enough to understand that timing the market is always the most challenging puzzle, a dangerous gamble that can bring an indescribable sense of joy when executed correctly. Success always bears the seeds of failure. The development of a trend will inherently create the momentum for its reversal. Every party will come to an end, and after every storm, a turnaround will always appear. As the famous investor Howard Marks once noted, success always brings the seeds of failure, and naturally, failure always brings the seeds of a new, hopeful beginning. If cycles are entirely driven by emotions, what causes the shift in investment behavior from greed to fear? Why do euphoria and gloom continuously alternate their positions in the market? The answer lies in how investors perceive risk in the market. When greed sweeps the market, most investors feel that risk does not exist. They believe they cannot lose money no matter where they invest, and this indeed happens for a certain period. This reinforces investors' greedy mentality, leading them to make riskier decisions in pursuit of profits because this is how they have made substantial money in the past. The more euphoric the market, the more risk accumulates until the market can no longer sustain this euphoria and begins the reversal process. At this point, investors with the highest risk portfolios suffer the largest account value declines, making them the ones most willing to sell all assets regardless of the market price. When fear dominates, the speed of sell-offs by investors intensifies, creating a self-reinforcing panic loop across the market. Instead of feeling that risk does not exist as in the euphoric phase, investors now see risk everywhere. They believe the risk is too great to invest profitably and therefore decide never to invest, no matter how attractive market prices may be. Consequently, most investors think the best approach is to stay out and wait until conditions stabilize. However, by the time investors feel comfortable to reinvest, the best opportunities have already disappeared. The change in risk perception in the market is always linked to the emotions that greed and fear evoke. This process is entirely subjective from the investor's perspective, creating an endless market cycle loop simply because humans always act emotionally in investing. The above explanation is an oversimplification by the author. In reality, there are many complexities and important details that only practical experience can provide. However, overall, this generalization still adequately describes the important points investors need to note. Always remember that knowledge alone can never fully its potential without the aid of experience. To succeed in the market, the ability to analyze cycles is an indispensable skill in the intelligent investor's toolkit. Recognizing which phase the market is currently in will help investors better prepare for potential future scenarios and seize attractive investment opportunities when the market undergoes irrational mania. Following the crowd's emotions has never been a successful investment formula. This is the reason behind Warren Buffett's famous saying, "Be greedy when others are fearful, and fearful when others are greedy." Frenzied stock buying and increasing margin leverage during euphoric markets or panic selling all assets during market crashes are the fastest paths to investment failure. Therefore, if investors cannot act independently of the market, it's best to invest passively in index funds. However, if investors choose active investing, the ability to separate themselves from the crowd is a prerequisite for sustainable success. The more euphoric the market, the more cautious intelligent investors must be in their investment decisions. The more panicked the market, the more daring intelligent investors must be to make bold decisions to seize attractive opportunities before they disappear. However, understanding what needs to be done is one thing, being able to do it is another entirely. Most practically, investing is more a game of psychology than of intellect. Although analytical ability plays a crucial role in investing, intelligent people are ultimately human and can easily be swayed by emotions like everyone else. If investing only required an IQ score, Nobel laureates would have all become billionaires by now. Even the brilliant physicist Isaac Newton was swept up by the crowd and participated in the South Sea bubble, ultimately losing all his accumulated wealth. Through this painful experience, Newton famously remarked, "I can calculate the motion of heavenly bodies, but not the madness of people." There are many uncertain factors in the investment world, but it seems that cycles are a rare exception. However, just because we know the market has been rising for a considerable period does not mean it must fall the next day. There is no certainty that a company overvalued now will experience a decline the following week. The cyclical nature is unchanging, but the timing of reversals and the intensity of each phase entirely depend on the market's behavior at the time it occurs. Investors can be certain that the market will fall after rising to high, and that it will recover after declining to long, but the exact timing of these reversals will always be a challenging question even for the best investors. As Howard Marks once shared, being right too soon is no different than being wrong. Investors might correctly identify that a bubble is inflating, but if they short sell too early, they cannot avoid losses. For example, some investors shorted the housing bubble from 2003 to 2008 too early and had to cut their losses because the bubble continued to inflate until 2008 before bursting. Were they wrong? They were not wrong about the market's direction, but they were wrong about the timing. Just because a bubble is inflating does not mean it cannot continue to inflate in the future. It only means the probability of the bubble bursting is increasing. However, the exact timing of the burst will always remain uncertain. You can accurately assess the current market situation, but if you decide to act too early, it is essentially equivalent to making a wrong decision. Intelligent investors understand the unchanging nature of market cycles, but they also understand that timing the market is always a dangerous gamble and certainly not for the faint-hearted. The market is riskiest when everyone agrees that risk does not exist, and the greatest opportunities arise when everyone refuses to participate in the market because they believe the risk is too high. Being intelligent alone is not enough. The ability to control one's emotions plays a more crucial role in investing. Isaac Newton's example is a typical case in point. Subjectively, the author believes that succeeding in investing is even harder than conducting scientific research. Cycles will always be a constant in the market, a rule proven by history through numerous phases of explosive growth and catastrophic collapses. For intelligent investors, the best profit opportunities always arise when most investors forget this rule.